Now, the forms of business organization. So typically we have three types of business organizations. One is the sole proprietor, other is the partnership, and third one is the corporation. So the first one, let's discuss the sole proprietors. An unincorporated business owned by one person is called a sole proprietorship. Often the owner also acts as the manager. This form of business organization is common for small retail stores, farms, service businesses, and professional practices in law, medicine, and accounting. In fact, the sole proprietor is the most common form of business organizations in our economy. From an accounting viewpoint, a sole proprietor is regarded as a business entity separate from the other financial activities of its owner. From a legal viewpoint, however, the business and its owner are not regarded as a specific entities. Thus, this owner is personally liable for the debts of the business. If the business encounters financial difficulties, creditors can force the owner to sell his or her personal assets to pay the business debts. While the advantage of the sole proprietor from the organization is its simplicity, this unlimited liability features is a disadvantage to the owner. On the other hand, we have the partnership. Partnership, like sole proprietor, an unincorporated business owned by two or more persons voluntarily acting as partners, co-owners, is called a partnership. Partnership, like sole proprietor, are widely used for small businesses. In addition, some large professional practices, including CPA firms and law firms, are organized as partnerships. As in the case of the sole proprietorship, the owners of a partnership are personally responsible for all debts of the business from the accounting standpoint. A partnership is viewed as a business entity separate from the personal affairs of its owners. A benefit of partnership over the sole proprietorship form is the ability to bring together larger amounts of capital investment from multiple owners. And lastly, the corporations. A corporation is a type of business organization that is recognized under the law as an entity separate from its owner. Therefore, the owners of the corporation are not personally liable for the debt of business. These owners can lose no more than the amount they have invested in the business, a concept known as limited liability. This concept is one of the principal reasons that corporations are an attractive form of business organization to many investors. The company used in our illustration is a corporation. Ownership of a corporation is divided into transferable shares of capital stock, and the owners are called stockholders or shareholders. Stock certificates are issued by the corporation in each stockholder, showing the number of shares that he or she owns. So the stockholders are generally free to sell some or all of these shares to other investors at any time. Okay, now, so you can see that reporting ownership equity in the balance sheet, it's very simple. Like if the business is the sole proprietor, so it will be mentioned, like let's suppose in the same example, JJ capital is debit. The JJ's capital will be posted like in this way in the owner's equity portion of the balance sheet. If instead of sole proprietor, if it is a partnership firm and the two people have invested the same amount of money, equally invested, like Jill Jones and Bill Jones, that is $4,000 each. So they will be invested and their partner's equity will be mentioned in this way. And instead of partnership or sole proprietor, if it is in a case of corporation, so owner's equity will be mentioned in this form, like whatever the capital stock or whatever the amount of money they have the firm has issued in terms of shares, so issued share capital plus whatever the retained earning or share premium, this will be added and it will become the total stockholders equity. So we have to discuss in detail in the upcoming videos that why it is important for all the stakeholders which are directly or indirectly associated with the business to go through the financial statements of the company, or a listed company more specifically, or a public limited company whose shares or stocks are traded in the secondary market like stock market. Because there are people who are associated with the business, like the investors, like creditors, like suppliers, like government, workers, many other people. So the use of financial statement by outsiders, so we are currently considering two main stakeholders. One are the creditors, other are the investors. The concern of the creditors and investors with the business, they are keen to know about the financial position of the firm, its financial stability, its liquidity position, its performance of the year. So, and their their ultimate motive is to evaluate or extract out the valuable information regarding the solvency and profitability of the firm. So the primary users of the financial information are investors and creditors, as I discussed, and there are two things which you need to understand. One is the return on investment and other is the return of investment. The investors, so the return on investment, like periodically the investors used to get dividends. Dividends are the fraction of profit the firm used to give from the earning per share, and it is decided, or it is discretionary power by the CEO or the elected director of the firm, that how much proportion of the earning per share paid out as dividend, and the remaining will be retained, and that retained earning will obviously increase the share price or the book value of the share. So the return on investment is the periodic dividends, and return of investment for the investor is the sale of ownership at a future date. The concern of the creator is very simple, that the return on investment, that they periodically and promptly get the interest. Secondly, they also worried about the actual or the principal amount of money what they lend to that firm. So the repayment loan at a future date. So the return of investment for the creditors, that how they will recover the actual amount of money what they have lent to that firm, and their return on investment is that they are regularly collecting the amount of interest from the firm. So finally, the need for adequate disclosures. Apart from these basic financial statements, notes to the financial statements often provide facts necessary for the proper interpretation of the statement. In the published account, apart from these basic financial statements, the firm has to disclose some information in the form of notes, so that all these stakeholders can get a valuable information. Thank you very much. Good evening, students.
Thanks for watching. For new video updates, press subscribe button so you will notified.